TGIF Warriors. I know. How you doing, Bran? So this to me looks like hi Jays.
We can't see your screen, Dale. Morning.
I know I'm slow.
Oh,
There it is.
There it is.
So
Thank you.
this looks like a very important chart to watch today. Be a breakout. Measurement 395 on the whole formation. So so if we're going to 395, is that going to impede the progress of the S&Ps to get to where a lot of the bears who've been patient are waiting to sell it, which is a line off this top, and a shade over 4,300. Since the diamond top, I think, is negated. That's the question. And what effect, if we get 395 yields, would you expect in FX came in?
Good early morning, Dale. Good morning, everybody. Well, I mean, that would be pretty simple, the dollar higher, right? Especially against those who are still low yielders, like the yen or perhaps even Swiss, perhaps. But yeah, it's yeah, the dollar is a wanted animal. Now, is it due to the situation in the US being better, or is it due to some debt ceiling stress relief, or is it due to expectations that the Treasury will need to dive into the market again? There's a lot going on about some liquidity shortage as well.
Yeah, because of the supply of treasuries that are going to hit the market because we've drained the coffers.
Well, somewhere there, but there's also a bit of stress regarding the TGA, the RPP, and whatever other short names we may give. And that's what keeping the yields now higher and the dollar very bit, especially against those who have a lot of dollar debt, which is still the case for China, Rand, and stuff. And
yeah,
many reasons why the dollar is bit right here and now. Now, is it justified that the currency is so bit? I don't know. We're coming to interesting levels there on some dollar pairs.
Stel, does 1920 look like a layup here? Are we going to turn it? I think we need a dollar turn to get the metals to go again. So I'm not, not sure we're there yet.
We are on the cusp. Gold support, I see, well, there's two levels, 1960 and 1970. So 1960-70 is an area which is very important. Right, the 1970 is the previous lows, and 1960 is the 23.6 from the November low to the May high. So that's, yeah, there you go. So that's, we're getting to one level, and then we have the other, the previous high there in February, which is also important. So we're getting to an area which is important. It will depend on the dollar, you very correctly said. I think yields are a tricky one because, short-dated yields are rising because of the whole debt limit concerns, which frankly, I think is going to be resolved at some point, hopefully earlier, and they're not going to let it go until the last minute and get a government shutdown or anything like that. But yields are a little bit more tricky, but you are right. We are on the cusp of a breakout. 362, I think, was the high, which we're almost there now. So yeah, we're on a holding pattern, waiting for news from the US, really. That's what we're waiting for.
For Biden to get back and ink a deal. So does it mean just because they have agreement on a deal that it goes through, they still have to keep both of their parties in line? And there's always people who say, well, I didn't want this cut, or we were looking for deeper cuts. So I don't know if it's a done deal just because McCarthy and Biden in principle agree to something. Now they have to get all these other people to agree.
Well, good point, but I think this is it's how should I put it? there's no alternative. They have to raise it. So they're going to
I don't
agree.
know.
They're going to
Trump,
agree, and they're going to bring everybody in line. But Biden is not Trump. That's the thing. And in many
yeah,
ways. So I
because
don't know
Trump
what's.
said let it happen.
Yep. Yep. You're
So
right.
I mean, there are a lot of Trumpians in Congress
Yes,
that
but
take marching orders from him.
yeah, but I think overall, I mean, if it's agreed by the two sides, there's going to be enough support.
All right, we'll get it over with already. That's all.
Well, yes, exactly. Meanwhile, we have more pretty important data coming out today, Philly Fed, and particularly we want to see prices paid, new orders, employment, all that, and the recent trend has been for pretty weak numbers. So the Fed's going to definitely be watching those. But like you said before, the dollar is grinding higher, and as long as the dollar is grinding higher, metal is going to be on the back foot, and obviously dollar pairs are going to be bid.
Okay, and not just a 10-year is at important levels. Longer dated treasuries are trying to break down here.
Yeah, those are driven by flow pretty much 100%. So it's a tricky one. Remember, I've said this many times. I used to sit next to the bond traders, the treasury traders at Merrill, and it was all, the long end was all flow. So it is interesting. We're getting to technical levels across the curve. But the bottom line, as we said on the flow show this morning, for the average US consumer, everything's more expensive. Mortgages have become more expensive. The housing is definitely not rising anymore. So the wealth effect, or the negative wealth effect, is starting to be felt. People are probably a little bit worried, layoffs left, right, and center. So it's really not a great economic. Oops, hold on, my microphone just got disconnected.
Okay. If we are breaking down, whether it's flows or whatever's moving treasuries, if we're breaking down, to me, that equals more bank failures.
Yes, well,
I mean, if they're having trouble now, the bond market's been stable since the gilt crisis. Okay, same with our bonds. So, if they're having trouble with bonds recovering with what's on their books, how's it going to look if bonds make new lows, new highs in yields?
Yeah, I mean, historically, it was a good sign if the curve was steepening. So the banks make money by lending out, right, long term and borrowing short term. But on this occasion, because it looks like risk taking has been a little bit, how should I say it, careless over the last years. You are absolutely right. As the bond markets start falling more, that's going to probably expose more weakness in banks.
Yeah.
It's a tricky situation.
That's what I'm paying attention to right now. And the dollar, someone said 103.5 is needed for confirmation. It's done nothing wrong since it turned last Friday, right? I mean, it looked like it was going to put it in reversal, but nothing wrong. So if we go to 395 yields, why can't we retest or even take out this high? I think, look at all this confluence, guys, at 102. Look at these moving averages converge there. That's not a trend line, a screen thing. And it's a daily. So, you probably say, oh, I'm late, I didn't buy the bottom, but you can move up. If you did get long from Friday's action, you should be at BE on your stops, or not much, because I don't think you want to see it close back under, on my platform, 102. So 102 is a pretty good pivot for the dollar, in my opinion. Else is around? I know Ryan's not here.
Ryan's still, he's out watching football, right?
Yeah.
Yeah, he will be back on Monday.
Oh, man. All right. Well, hey, and by the way, that was the match that you guys were talking about last night. It's funny. I always get to watch the recaps here in the US. That's kind of like my evening things, like all the games that happen for you guys in you know, in the UK and Europe, I end up watching like the highlight reels, you know, a couple hours later. And what was that, man? It was
Manchester City.
Manchester City.
Right.
That one forward, that striker, the real tall blonde dude.
Haaland.
Haaland.
Yeah.
That dude's a beast. He's a beast.
Yeah. So much power, right? Yeah.
It's unbelievable. Anyway,
talking about beasts, here you go.
Yeah,
So we have a throw over on NASDAQ 100.
Well, the DAX as well.
Yeah, I mean, look at the DAX. Look at the DAX. Look at the Nikkei. Oh, pull up the Nikkei. Have you seen the Nikkei?
Go ahead, grab them, buddy.
Nikkei is approaching the all-time high.
Yeah,
Well,
what's it take? 30
so
years?
is the DAX. So is
yeah,
the DAX.
not all-time highs, but we're approaching highs. I mean, we're approaching levels that we haven't seen since 1990. I'll take the screen over here. But let me remove a couple of things. I was just in the midst of doing something. But you know, yeah, we got let's start off with the DAX. So here's the DAX. Now the DAX is approaching all-time highs, right? I mean,
Yeah.
that is a genuine, like, massive breakout about ready to happen. Which, you know, is surprising to me, but it's not surprising price action wise, because all we've been doing for the last month is consolidating
Consolidating the gains, yeah.
right above the highs. I mean, you know, if you sit here and you look at this and you're short, you know, like, let's just say you're watching this over the last month and you're sitting there shorting it, you know, the chances are is it's going to squeeze right in your face at some point. It's just a matter of time. You know, everybody gets frustrated. You know, people are waiting for pullbacks to get long. People are waiting for you know, their shorts to develop, and they never do. So next thing you know, you get squeezed. So you got the DAX and I think it's in a wedge, but that doesn't mean we can't get a throw over, right, Dale? I mean, you know,
Yeah, we're getting one in NASDAQ.
Yeah, well, before you get all crazy about NASDAQ, I mean, look at the Nikkei. Now, if you look at the Nikkei, let me pull this chart up. Let me pull up a different feed, because I want to go look at this a little bit more longer term. Let's go to a weekly chart, and let's go back out to 1990. I mean, look at Nikkei and where it's at and where it's been in the late 80s. I mean, that's pretty massive. K-Man, you spent a lot of time in Japan. You spent 5 years on a trade desk in Japan, you know, trading around. And when I'm actually going to ask you about something else about the Asian markets here in a second. But what are your thoughts here about the Nikkei moving the way it's moving?
Well, I spoke about it on the Flow Show. I see 5 reasons why the Nikkei is up here. There is decent inflows again. The Japanese investors need to invest fresh money in the new fiscal year, and that is one of the reasons they invest. They have a preset portfolio investment style, and that is one of the reasons why we are here. The other one is that the rest of the equity markets are pushing higher again, and then. The other one, what was I saying this morning again? Yeah, that's and there's one good reason as well, is the copy traders for Warren Buffett. Buffett told us he was investing in Japan earlier, and that works really well. And now a lot of people want to invest in Japan as well. And the GDP beat earlier this week. We have a CPI out, by the way, next
tonight. Yeah.
And so there's a lot of good reasons why the Nikkei is higher. Also the correlation with the yen, but that's a bit like the chicken and the egg. Who was first? But when the yen weakens, typically the Nikkei strengthens as well. Especially when we are in an inflationary environment. Deflation is a bit of a different story.
Yeah, it's interesting. And, you know, while I got you here, K-Man, I want to also just talk to you guys about the US dollar CNH. Typically, when you see a move in the US dollar CNH like you do here, we got a breakout. I mean, look at that. This is a massive breakout, right? I've always tried to look at this from a stock market kind of point of view, and I'm going to pull up the S&P. Yeah, this is one
I
of those.
know
That,
who you read.
huh?
I know where you saw that.
No, I've looked at this literally for the last several years. This is something I always look at. So whenever we always talk about, we've been talking about this for years, K-Man.
Then
The
somebody
US
else-
dollar CNH and the inverse relationship between the S&P. So whenever it breaks higher, I always start to like look at the S&P, but it's a very similar relationship to the dollar index. And so when the dollar index does the same thing, you know, which we're rallying right now, you ask yourself, is it more of a risk aversion type of move, or is it, you know, is it a a move because of something else? Like for right now, you look at the 10-year in the US 10-year and it's rallying, and you're like, okay, well, is it, this a dollar move? Maybe it's a little overbought, but we're not seeing the moves with the Aussie breaking down. So, I mean, we are, but it's not like completely breaking down. So I'm not too worried about risk off, but the US dollar CNH, and that's why I wanted to ask you this morning.
Yeah.
We're seeing it rally and we're seeing it break out. And a lot of times, as we've seen in years past, you see an inverse relationship, and you get a move higher in the CNH, S&P breaks down. We're not seeing that right now yet. What are your thoughts here?
Yeah.
That is a
First
great
of all-
insight to share, Blake, with everyone.
First
Well,
of all, sorry, then somebody else must have copied you, because I read exactly the same. I saw exactly the same thing on Twitter this morning.
Blake
yeah, no,
doesn't
this
copy
is
anyone.
this is something that
I'm
we
sure,
discuss
but-
from time to time here.
So what happened?
No copycats here at ForexAnalytix. We don't need them to
Yeah.
do that.
So what happened?
Except
there?
we all copy each other. I'm
Okay.
kidding. Go ahead.
So what were you saying, Kay?
Yeah, I'm still here.
Oh,
No, so
come on.
there's a couple of reasons for why the CNH is weakening now, but the major reason, first of all, was geopolitical, with all the problems, the issues that have arisen when they went in ship with the Russians, then trying the Taiwanese thing, and then now we've got the accelerator. Now is the dollar and the higher yields. Regardless what anyone may say, the Chinese still have a lot and a gigantic amount of dollar debt, and yeah, I mean that's and you add now this technical break above 699.5 7 is pretty telling, and there's several reasons that now underpin the dollar China, especially that investors are not really keen on diving too much in China right now. If the geopolitical situation resolves itself, then we may have different picture. There is an interesting level here, though. It's at 703.70. I've got it on the dollar CNH, and that's the 50% of the whole move lower from last October to January. 703.70 I've got it at, and so we are hovering just above there.
Yeah,
You've got it at 704. Yeah, it's there.
I want to say that one of the things that gets my attention, when I get up in the morning, which by the way was only about an hour ago, the first thing that I do is I go and I start trying to read stuff, just kind of like I watch a couple of videos, I kind of listen to a few things, and I watch things, and it's like literally trying to get up and real quick put a puzzle piece together in the morning. But the absolute first thing that I do is I go through, I look at like a lot of these major, instruments that I'm following. I have a couple of different lists that I go through. And when you see something like the US dollar CNH, which is a managed currency, by the way, up 0.5%, that's alarming to me. Like, when you get normal FX pairs that are unmanaged, that move or are currencies that move 0.5% or 1%, or sometimes if you're dealing with emerging market currencies, maybe 2%. If you see a big move like that, it's like, okay, whoa, what's happened there? But when you see a managed currency like the US dollar CNH breaking out, that does really, get my attention. And that's why, this morning I'm like, shit, what did I miss? What did I miss overnight? But I also know that you got the dollar yen that's about ready to break out. That looks really close. You got yields moving. You've got some stocks that are breaking out to the upside. That's why I was like scratching my head going, hey, why? Because usually you would actually see the opposite reaction in the US dollar CNH. It's a real interesting setup.
You had the weaker numbers as well, right? The start of the week, you had the weaker numbers as well out of China. You had industrial production only produced half of what was expected, right?
Absolute crap numbers out of China. And, a lot of people have been betting on this big China recovery trade, over the last, several months.
Copper.
Yeah. I mean, they're, whether you're long copper, you're long China 50, you're long, the Hang Seng, whatever you're long. And then here's copper. It's not working, right? It's scary. So anyway, just a few thoughts there. A couple other things we should probably talk about, since we do have unemployment claims coming up. We've got, I know, Dale, you already mentioned it. You got the dollar index. It's turned higher since last week. And here's the thing I want to point out about the dollar index, just technically. If you guys don't recall from earlier in the week, we were really, last week, we were looking for a move past the 38% retracement, and which, we are up above it now. Pullbacks have been shallow pullbacks, and you can see this move right here. And I'm going to have to move the fib anyway, but we aren't even reaching for 38% retracements in the dollar index. So when you're not even pulling back a 38% retracement, that's telling you that the move is really shallow. And it's not giving shorts the opportunity to exit. It's not getting people that want to be long the dollar opportunities to be long. And that is something that, it just suggests that we're going to continue higher. Now, we are approaching, in my opinion, on the dollar index, probably a pretty key level of resistance. It is 50% retracement. I say key level for the week, I think. Although I know we've discussed this, and I think Steve chimed in here yesterday, and I think we've all kind of discussed, the dollar index getting back to the 200-day moving average in a longer term bearish consolidation seems very logical to me. And remember, we do have unemployment claims today, and I think we have Philly Fed, which I think we need to be watching the Philly Fed numbers, because they have been missing to the downside quite a bit. So just something.
Previous number was atrocious, minus 31.3.
Yeah, if you look at just thanks, Steve, and
today's number, is also expected to be horrible, like minus 19.8.
Yeah, let's look really quick. I'm just going to give you an idea of what that looks like. Today is Thursday, right? I think what today is. Here is the Philly Fed. That's the employment numbers, by the way. There's the manufacturing index, the Philly Fed employment component. But if you look at the history here, you can see the misses have been by a broad margin, quite a bit, this year. You can see them all right through here. So last month was atrocious, but look at how we're missing, and, by the margins over the last couple of months, which, some people are going to take that as more of a leading indicator to the U.S. economy. So just take that into account when you're dealing with today. Also, I think we should also, let me delete this really quick, take a quick look at the unemployment claims. Let's get rid of this, or initial jobless claims rather, and just look at the data, how it's turned really this last week by a larger margin. And that's what I care about the most. And I'm not so much looking at the headline number and saying, okay, well, it's still only 260,000, 264,000. It's not a really big number. I'll get concerned when it's above 300,000. No, it's the jump from 245 to 264. It's really that first time we've seen a bigger percentage move in the weekly unemployment claims. So I want to make sure this is not a trend. I think people that are following this data don't want to see that develop into something like, we're looking at 254,000. We don't want to see a 280,000 print today. That would scare the bejesus out of some people. So I just want you to be thinking about that as we're watching today's data as it gets released. Okay, real quick, Steve, I heard your voice. We have just a few minutes before the data is released. What's your thoughts this morning? Just looking around as a European, glancing at everything that's happening. What's going through your head right now in the markets? Not anything else.
I'm paying close attention to. I talked about it yesterday. Yields and USD yen as we speak, not coincidentally, of course, are both testing key resistance areas. We're talking about 3.6 in the case of yields, and we're talking the 137.70, 137.80 horizontal resistance area in the USD yen. So that is definitely. I can see one thing, because we know they move in tandem, that people should pay attention ahead of the data, because today's data might either lead to a rejection from here, and which means we remain trapped in the recent consolidation, or to a breakout, which I think is going to be technically very significant.
Hey, Steve, just for people that look at harmonic patterns, this is what I'm looking at, just so everybody can see it here. I'm looking from the 142.
I don't disagree with you. I think we break through current resistance, and it's likely we're going to be headed there.
I was saying that a month ago, and thought we'd get there, and then I gave up on it on that break that we had.
And sometimes, Dale, you got to just let the markets have to develop a little bit, and the reasonings have to line up, and hey, maybe we get a debt ceiling deal. So anyway, sorry, Steve, didn't mean to interrupt. Go ahead.
No problem. So that is definitely one thing I'm paying attention to. I'm paying attention to silver, which for the, fourth consecutive day is backtesting the broken channels, trend line resistance as support. So that is also very significant. And today's data also might lead here to either another rebound from this trend line or to a break low, in which case we might see silver correct even lower. Gold is also testing horizontal support resistance area at 1970. In general, we have cable breaking down from an ascending channel, but theoretically speaking, by the end of the day, that might be invalidated. So technically speaking, we have a lot of markets.
All about the dollar, isn't it?
Yes, of course. It's always about the dollar, right?
Yeah.
With of course yields, at a big extent indicating direction.
But by the way, did you guys? I don't know if you guys saw the Aussie employment last night. Really horrible numbers. Slammed us back down towards the 78% retracement. Really, I mean. You see copper, you see the dollar, you see what the dollar is doing across the board. I mean, the euro.
There's a little bit more distance in the Aussie, Blake, in the Aussie USD, before we actually break down. But definitely all the recent price action has purely corrective characteristics, right? There's nobody that will see this chart and say that I'm seeing a lot of momentum and strength to the upside, despite having held the lows that we posted in March. The whole price action following that has been more of a bearish consolidation. So I think there is a good possibility that eventually we're breaking lower there.
Yeah, it does feel that way. Hey, real quick, I'm gonna pull up on ForexAnalytix. For those of you guys that don't know, if you go to the calendar tab and you click here where it says Open Data Flash, this will give us the data as it's coming out. I'll push that over to the side and I'll pull it back here in a second, but we're going to grab the dollar index. We're going to see what the dollar index and its response immediately to this data is going to be. Now, remember, unemployment claims, we just want to make sure that they're not jumping like they did last week. I mean, that was a sizable percentage move that we have not seen, that's been so steady for so many. I mean, I don't know how many, somebody can go back and count, probably for the last 2 or 3 years that we've been steady, maybe 2 years, that we've been steady at these levels. And you're seeing those percentage jumps. It does freak me out a little bit. I'm going to pull up actually yields, since we're closely watching yields. That'll be over here to the right. You're going to see the S&P right in the middle. You know what? Let me do something here with the S&P.
5 seconds.
What is it really? Okay,
Yep.
there it is. Okay, there's the data. There, dollar is to the left. Okay, there you go. Let's see what those
Canadian data in line. Who cares? The Canadians probably actually.
Most likely, yes.
Yes, that's
I
probably
don't
true.
see it. I don't see it yet.
Let me call Adam. Ask him.
Oh, better than expected. Pretty
Wow,
much
Philly
everywhere.
Fed
Still
came in,
negative.
yeah.
Still
Except
negative.
employment. Employment's
I
worse.
think
Look at the 10-year yield.
Yeah, that's a
Double trades are
it's a
242.
breakout unless it fails now, guys.
What'd you say,
Initial
K-Man?
jobless claims.
242.
Yeah,
Yep.
initial jobless claims. Okay, somebody can say a little bit better than expected. All in all, I think the market will see it as in line practically. So definitely not a bad number, right? And somebody can say that Philly Fed was also a positive number, although you have to be very careful when you consider a minus 10.4 being a positive number, right? I mean, it's less bad than expected, but from there to considering it positive, there is a big distance.
Watch yields, they are on the move, you
Yeah.
know, across the curve, even the shorter end, but the 10-year, 30-year, trying to move higher. It's obviously given a little bit of a boost to the dollar yen, which is nearing the stops above 138. If you guys are short dollar yen, I'm sure your stops are sitting around 138, 138.10, 138.17.
I hear there's only one stop loss there, Blake.
I'm
A one
going to
lot.
make the
Only a
assumption
one.
that, what's that, Dale?
A one lot.
I know you got a joke. Go ahead. Let it go. Let it go.
All right.
What did you say? I missed it.
Oh, that there's one lot above that level for a stop. There's only one.
Only
Not
one.
thousands. Yeah. I was being facetious. Yeah.
But yeah, I'll tell you what, the markets and every desk trader right now that trades FX around the globe is licking their chops going after your stops. Oh, that rhymed. Look at that. Hey guys, make sure you check out ForexAnalytix when you get an opportunity. Jump in our community. We have probably one of the most active trading communities out there. You can see all of, not only
What's
this is
that?
like,
Fly tops.
I was talking about a gnat in my office this morning, and Amir put in this like fly. You remember those, Dale, right? Those are old school.
1917.
Yeah, you know, we have conversations about all sorts of things in the chat room, but then you see the threads off those conversations. So that's just in the general chat room. Then you have obviously the S&P room, which is a really S&P and like indices room. Then you got like the macro chat room, the Flownomics room. This is usually where Ryan and K-Man are at most of the time. Then you got the trades room where you see, you know, what we're trading, what we're buying, what we're selling. Not everybody posts in there, but most of us do. And it's really one of the best communities around. And so make sure you check it out with ForexAnalytix. I'm going to turn it over to you, Dale, because one of my favorite guests that you bring on, Mr. Peter Bookvar, is here. So I'm going to let you interview him. And so you guys, team, Steve, Stelios, K-Man, thank you all for being here today, and all the best to you guys today. Good luck in your trading.
Thank you, mate.
All right.
Yeah. Thank you, Dream Team.
Enjoy the interview with Peter.
Okay. Hi, Peter. Welcome back, buddy.
Thanks for having me.
All right. So, you know, we have some data here. Why don't we start with, first, let me ask you what's top of mind for you with, you know, we haven't talked in a while. I have your blog up here. What's your key takeaway from and what you're focused on going into the debt ceiling and what happened with banks? And to me, what's top of mind besides being squeezed on the short side of NASDAQ is the move that we're getting in yields, Peter. I don't think people are expecting yields to head back to 390. You know, technically it looks like it could happen. Do you think we're headed back up there?
Well, a couple things. When you look at the economic data, in my opinion, it's doing nothing but soften. I listened to a lot of company conference calls, stocks we own, stocks we don't own, but just to get a sense of obviously the micro, but certainly the macro. And challenging macro economic conditions, I think I heard in every single call that I listened to. And
Interesting.
there's a clear, broad economic slowdown going on. And
Is that
you know,
what Copper's saying, Peter?
I believe so. You know, when you hear a retailer saying people are buying more food, beauty, and drugstore products and less of everything else, yeah, that tells you a lot about this state of the consumer. Capital spending slowing because profit growth is slowing. So to me, there's a broad slowdown, and whether it's a recession or not, it certainly feels like we're at best not growing, and at worst about to head to an economic downturn. The interesting thing about rates is that in the face of that, we're seeing obviously this uptick in interest rates, and we're seeing, and not just here, but even today in Asia, we saw a rise in rates. In Europe, yields are up about 10 basis points across the board. So we have this sort of stickiness in the level of interest rates. Now, granted, a lot of it has to do with monetary policy and pushing up short rates, but even long rates, you know, the 10-year in the US now north of 360.
Yeah.
Now, there's obviously a lot of noise around the debt ceiling, which it is noise. It'll get raised. But we also have to think that when it does get raised, so the Treasury General account, which is basically the bank account, it's down to about 96 billion. I looked at the website today as of Tuesday. And so once it gets raised, Treasury is going to sell at least 500 billion of treasuries rather quickly. So it's going to spike, and it's going to suck out a lot of liquidity. And I would have to believe that has a lot to do with the jump in interest rates over the last couple of days.
Okay, could it be that people are going to have to learn that rates could go higher, not because of economic growth, but because of supply, and that you could have higher rates in a weak economy because of supply? Do you think that's
and also stagflation?
Okay, yeah, and inflation not giving up the ghost at the same time. So the bonds could be bad even though the economy is weak, because we just have to keep financing this. And it's not just here, it's everywhere, isn't it? There's just not enough, there's too much supply for demand to absorb in the global bond market, whether it's gilts or it's notes.
We had an epic bond bubble that was ethically defined as a negative interest rates, which is the epitome of a bubble, where it's the ultimate hot potato. And when people ask me where do rates go, well, I argue, well, short rates are probably have peaked, but with the 10-year, I can make the argument that the 10-year goes to 4.5, but I can also argue that it goes to 2.5 to 3.
You're right.
The point being is that it would go to 2.5 to 3 in an economic recession and inflation continues to fall, but it goes to 4 to 4.5, not because growth accelerates or necessarily inflation does, which it could, but because of this continued bond bubble unwind and supply, and how does the Treasury market absorb QT, not just here, but also in Europe? How does the world's bond markets absorb when I believe the way that in Japan is going to widen yield curve control at some point in the next couple of months?
Why is their equity market melting up in a parabolic fashion, Peter?
Well, even with this, the Japanese TOPIX is still about 25% below where it was in 1989.
Yeah, I know.
You have attractive valuations. You have rising returns on equity. You have appreciation for the changes in corporate governance. You have Japan is a big beneficiary of a China reopening, and what that means for growth in the Asian region, and why while the China reopening has really been mostly isolated to consumer spending on travel, leisure, hospitality, and so on. Well, pre-COVID, a quarter of, maybe it's up to even a third of Japan's tourists came from China. So if the Chinese start traveling again, Japan's going to be a beneficiary of that. And I think it's not just Japan. I mean, look at European markets this year. I mean, the Euro
Yeah,
stocks
they're outperforming.
50 is up 15% this year. It's double the pace of the S&P. So it's not just Japan, but listen, we've had 10 years of dominance of US markets relative to everything else, mostly because of big cap tech. And while big cap tech is having, it's day in the sun again, because people can't give up the hope that these stocks will continue to dominate.
Am I crazy to be bearish Apple up here, Peter? I'm in set puts.
I mean, I think it's okay to be bearish on all these big cap tech companies. They're great companies, and AI is really exciting and everything. But yeah, I mean, Google search itself is AI. Therefore, AI has been going on for decades. And yes, this iteration is very exciting, but I think that the hype in the short term is going to overwhelm reality. And we've seen this movie before. For anybody that's been in the markets for many years, is when you get this sort of differentiation in markets, it doesn't always end the way you want it to. And it's not usually the laggards that catch up to the winners. It's usually the winners that catch up to the laggards. Because when you think about it, if let's take the S&P 500. If 7 stocks are doing great, 493 are not, well, who are the customers of those 7 stocks? It's the other 493. So you can't just keep buying the 7 stocks.
Great point.
When the 493 are your customers and they're seeing slower demand and slower business themselves.
Yeah. Okay. Hold on a second. Chat GPT isn't working. It's been sending me the questions for this interview. Oh, here's one. All right, it's working again, Peter. So Blake brought this up today. Any comment? He's talking about an alarming move in a managed currency. Any impressions on what's happening with China's or reopening? I know you thought that it was going to be a pretty strong reopening. Is copper and what the yuan is doing saying otherwise? That was it? It was, burst and it's petering out. Plus, you got some pretty bad data out of China this week.
The China reopening has been robust with respect to the consumer. You look at the Macau numbers; they're robust. They're almost back to where they were in 2019. Look at domestic travel. You look at restaurants. Yeah, it's robust. But copper, China manufacturing, Chinese exports is still subject to global activity, and copper demand is still subject to the Chinese residential real estate market, which is challenged anyway. So you have to sort of differentiate what's happening in China, but over time, when you liberate 17% of the world's population after 3 years of lockup, you're going to get a nice reopening, but it's not going to all happen at once. And again, China's manufacturing sector is still going to be dependent on demand from the US, demand from Europe, demand from other parts of the world.
Okay, interesting. You talk about what consumers are buying. That shows that there's concern about their personal liquidity. Yet when it comes to things like Memorial Day and travel, it's almost like we have two economies that even when people are broke, they're going to find a way to take that vacation, right?
Well,
they may not go out and buy things at the store, but they're going to spend money on the experience because of the lockup. People feel I think it changed a lot of people's attitudes about the future. The future is now. People used to save for the future. Now the future is who knows what's going on. We never thought we'd be locked down like that. Time is more important to me than money. I want to do what I want to do now. I'm not going to delay gratification.
Well, it's that, and also it's the prioritization of what people want to spend their money on. And after spending a lot of money on a lot of things, goods-wise, over the last couple of years, if I'm not repeating that spending, well, then I have extra money to go out for dinner and go to a live concert, or go to a baseball game, or get on a plane and travel somewhere. So it's the prioritization, it's the shifting of spending habits. I think in the aggregate, retail sales is definitely moderating. And as I said earlier, consumers are becoming more sort of discriminating and where they place their money in. But if I'm not buying a piece of furniture would have cost me $500 to $1,000, well then I got $150 to go see Bruce Springsteen if I can get a ticket like that. So we in Stock and Live Nation, and their quarter was pretty robust. And it's not just in the US, but the consumer feels like live entertainment is where they want to spend their bucks. And but that's just sort of a shifting thing. But I think in the aggregate, you can only push price so much. And it'll be interesting to see after the summer whether a lot of the leisure desires have been satiated, and then the consumer starts to retrench on everything. That we'll have to see.
Do you think the market is ignoring the fact that what happened in our banks is the problem is not the failure of those banks, but credit tightening conditions are going to be, really the fallout from it? And then I'm showing the TLT here, Peter. And, a few weeks ago, I thought we could break out over 109, but now we're threatening a breakdown here. Again, the supply deal. Isn't a new low or a new high in 20-year paper going to take down more banks? I mean, if they're going down, go ahead. I'm sorry.
No, go ahead. Finish up.
Because they're going down with the bonds really having stabilized for about 6 months. So another wave of selling in bonds that take yields to higher levels than they were last fall, I have to think is going to exacerbate what's already happening in the banking industry.
Well, a couple of things. I think what's keeping the stock market at these levels is, now granted, it's very bifurcated, as we talked about, with everything outside of the top 7 or 8 stocks doing poorly relative to the top ones. But there's also the attitude of, I don't want to miss the end of the Fed rate hike rally.
Okay.
How many people don't want to miss that rally? Oh, the Fed's done, I got to buy stocks.
Yeah.
I mean, it's about $1 for every time I heard that. But I think that's missing the reality that just because they're done hiking doesn't mean that they're quickly cutting, and that by leaving rates high for longer is a continued form of monetary tightening, and QT is still going on at a pretty hefty level. I think with respect to the banks, I think the Fed's program, that the lending program that they put in place, where you can pledge 80 cents of MBS and treasuries and borrow 100 cents back, even though that money has to be repaid in a year. I think that's relieved some of the duration risk on bank balance sheets. I think the biggest risk to banks is on the credit side, in that we see what's unusual about what's happened with the banks is, historically speaking, you go into an economic downturn, delinquencies rise, credit quality deteriorates, and that's what takes down a bank. This time around, it's been completely reversed. It was the widespread between deposit rates being paid and the risk-free rate in, call it a money market fund. At the same time, we've had this duration problem. This is even before a credit cycle occurring. So now we are on the cusp of a credit cycle. But I do think that the duration issue and the implicit deposit guarantee can at least contain bank failures for that catalyst, where the upcoming potential bank failures is going to be more of I've extended myself too much in commercial real estate, for example.
Yeah.
Now, that said, the historical loan to deposit ratio in the US banking system is about 70%. Now it's only about 60%. So it is possible that we don't have really, even on a credit down cycle, too many bank failures. To me, the more of the risk is just a general credit squeeze, which I think we're clearly in the midst of here.
Okay. Yep, that's the lifeblood for American business, right? The small, medium-sized business, regional banks. That was a symbiotic relationship that worked for a long time, and business lost that partner in the last several months, haven't they?
That's absolutely right. Someone who wants to open up a couple restaurants and borrows money, Goldman Sachs is not taking their call. The U.S. capital markets are not doing a bond deal for Joe Schmo barbecue restaurant in Middle America. You got to go to your local bank, and if you can't get it from your local bank, you're gonna have to stump up for more equity. And that's what that's what we need. We're going to need more equity because there's going to be less access to debt. And after relying so much on debt over the many years and less on equity, it's going to have to be reversed.
Okay, well, CEOs have been depending on equity. That's why they buy their stock back.
Right? Yeah, well, they've done that a lot by borrowing money in the debt market to buy back
and then buying their
equity.
stock.
Right, but they're accessing the capital via the credit market as opposed to their cash flow. Now, some aren't obviously doing it through cash flow, but you get the point.
I think it's the first time in my career where I've seen sovereign bonds, which are supposed to be, treasuries, which are supposed to be the best of breed, if you compare to corporate and junk, holding up better than sovereigns. Is there a message in that?
Well, with respect to corporate credit, it depends on the duration of what we're looking at here. If you look at high yield, a lot of high yield is more shorter duration than investment grade. So investment grade has sort of traded with the U.S. Treasury market because of the historically high level of duration. So I think it's important to make that sort of distinction in duration levels. And then you have part of the corporate credit market, which is floating rate, which has actually benefited from the rise in short-term interest rates, even though credit quality is much weaker. I do think that the corporate credit cycle is what comes next in an economic downturn, but I think that's part of why it's held up. Also, getting back to the point I made about stocks is no one wants to miss the Fed is done rally, and that has also, I think, kept corporate credit spreads relatively tight to where you would think otherwise.
Do you ascribe to the statement that if I could get the dollar right, I could get everything right, all one market, dollar really driving it? Chicken, egg, yields, or dollar. Do you think that the move that started Friday over 102 has legs here, Peter, under current market conditions?
If we go back and look at what was the driver of the dollar, and I'm going to have a starting point of June 2021, it was all the Fed and expectations of how aggressive the Fed would be. June 2021, Jay Powell at the FOMC meeting said, we're now thinking about taper and QE. That is what lit the match under the dollar rally. And when did the dollar rally end? It ended at the end of October, just as the Fed ended their cadence of 4 meetings in a row of 75 basis point rate hikes. So it was solely tied to the aggressiveness of the Fed. And once they started to tail off in that aggressiveness, the dollar topped out. The only reason why the dollar's rallying here is because Fed speak over the past week or two has sort of raised the possibility again that maybe they need to hike again. I think they're done. I don't think they go in June, but I think that is what has helped the dollar rebound here, coincident with the 2-year getting back above 4%, now at 4.25%, because of that. But once I think we see that the Fed is not going to hike again, I think we'll head back down on the dollar.
Okay, so at best, a bear market rally. I know some people are saying that we could, once we get through 103.5, that's going to squeeze it. Plus, you do have a lot of dollar bears right now, Peter. I mean, CLT data. If we do get a dollar rally, it'll be the most hated dollar rally in a long time. So,
yeah, I mean, you can say sentiment has gotten a little pushed here on the bearish side, but we also have to look at the dollar more than just against the yen and euro. I mean, a couple of days ago, the Mexican peso.
Yeah.
I mean, even with this little bounce here, I'm going back to
you're right.
2016, the last time the Mexican peso was this strong. So the dollar is pretty weak underneath the surface here.
Yeah, we used to make fun of the peso. I mean, there were all kinds of devaluations. People. I can't remember the last good bull market in the peso.
The peso is benefiting from hopes of supply chains diversifying to Mexico from other parts of the world.
Yeah. Okay. Maybe we should open an office down there, huh? Puerto Vallarta, Peter?
Or own some industrial real estate or some factories.
Okay. As long as I don't have to work on it.
No, you would just collect on it.
Okay, I'm in. So, I recommend everyone include this in their intelligence gathering, keep a tab on what's happening economically with Peter. Go to his book report, and you can find Peter on Twitter at pbookfar. Anything you want to close with, Peter? It's been great talking to you again.
That when the debt ceiling gets raised, to my point earlier, Treasury is going to sell hundreds of billions of dollars of treasuries. Treasury general account will jump up, and that could be a reversal of some of the easy liquidity we've seen as they've drawn down that facility. At the same time, the Feds will be doing QT, and their balance sheet will soon get below where it was right before SVB went down.
Are we going to take out the October low before we make a new high in the S&Ps, Peter?
Yes.
That's a pretty easy call. Okay. You think it's this year or next year?
I don't know.
Okay,
I would guess the latter part of this year.
Okay.
Would be my
negative
guess.
fall. Okay.
Yeah.
All right, Peter. I really appreciate you coming here. I enjoy talking to you every time we're here. Because I could ask you anything, and appreciate your insights. Thank you.
Thanks, Dale. I appreciate having me.
All right, everyone.
All right,
Peter Bookfar, and subscribe. It's free. He also has a paywall for his elite stuff, but pay attention to Peter, and when you see him on CNBC, turn up the volume. Okay.
Thanks.
All right, buddy.
Bye.
My trading warrior brother, Peter Bookfar, everyone. Have a great day trading. You could join the team in about 18 minutes on the morning edge, and don't just count your bips on the 10-year going to 395. Count your blessings. And I'll see everyone for TGIF tomorrow. Adios. Thank you, Peter. Oh, you're welcome, Rick, Patrick, all you guys. Enjoy. I'm glad you enjoyed.